Something big is happening right now in silver, and if you're watching this today, the timing matters. In the last week alone, silver collapsed from $121.64 down into the low 80s, wiping out roughly a third of the price in days, not months. And here's the part most people are missing. Tonight, the CME margin hikes go live. Both the CME Group and clearing members have confirmed silver margin requirements are jumping about 36% into the close. That's not commentary, that's mechanical reality. Stay with me, because I'm going to walk you through what's actually driving this move, how to spot it next time, and why tonight's close could tell you a lot more than tomorrow's headlines ever will. Before I explain what caused this, let me teach you something most people don't really understand about futures markets. When you trade leveraged products, you're not just betting on price, you're renting exposure with borrowed money. Think of it like driving a sports car on credit. It's fast, it's thrilling, but the moment the lender demands more collateral, you either wire cash immediately or you hand over the keys. That's the reality. Margin isn't punishment, it's a risk control. And when margins rise suddenly, the market doesn't politely adjust. It scrambles. Prices don't fall because demand vanished overnight. They fall because people are forced to sell right now, whether they want to or not. Now, when you hear the word margin, most people think it's just about putting up more money, but it's deeper than that. Margin is the buffer between you and liquidation. It's what stands between staying in your position and getting stopped out automatically. So when exchanges raise margin requirements, they're essentially tightening the leash. They're saying the risk environment changed, and if you want to keep playing, you need more skin in the game. But here's what happens in practice. Not everyone has that extra cash sitting around. Not everyone can wire funds in hours. And that's when the cascade begins. Think about it this way. If you're leveraged 10-to-1 on a silver position, and margins jump 36%, you're not just adding a little bit more money. You're scrambling to cover a meaningful chunk of capital that you maybe don't have liquid. So what's your choice? You sell, you reduce, you exit. And when thousands of traders are doing the same thing at the same time, you get what we're seeing right now. Forced liquidation. It's not a choice, it's a requirement. The market doesn't care about your thesis or your timeline, it cares about math. So what does that tell us? It tells us that price moves during margin events aren't necessarily reflecting true value. They're reflecting structural pressure. They're reflecting who has balance sheets and who doesn't. They're reflecting who can hold and who must fold. And that's a critical distinction, because if you understand that, you stop panicking when you see these drops. You start asking different questions. You start asking, is this fundamental or mechanical? Is this real demand collapse or forced selling? And those questions change everything. If this is making sense so far, drop a comment below. Tell me if you've ever been caught in a margin squeeze before, or if this is the first time you're seeing how these mechanics actually work. Because I want to know who's watching and where you're at in your trading journey. Now here's what's actually happening under the hood. The CME announces a roughly 36% hike in silver margins, effective tonight. That means every leveraged long has to post significantly more cash before the close, or their position gets reduced automatically. Now layer on the timing. Spot silver is sitting around $81 to $82 an ounce today, already down about 33% from last week's peak. Liquidity is thin because volatility scared people away. So when that margin call clock starts ticking, sellers don't wait for a better price. They hit bids. Fast. Forced liquidation feeds on itself. Price drops trigger more margin stress, which triggers more selling. That's the cascade I'm talking about. Let me break down the sequence step by step, because the cause and effect matters here. First, silver runs parabolic. It goes from reasonable levels up past $120 in a short window. That kind of move attracts speculators. It attracts momentum chasers. It attracts people who are using maximum leverage to squeeze out every dollar of return. And all of that's fine when the move is going your way. But parabolic moves also attract attention from risk managers at the exchanges. They look at volatility metrics, they look at margin utilization, and they decide whether current margin levels are sufficient to cover potential losses. When volatility spikes like it did, they decide they're not sufficient, so they raise them. Second, once the announcement comes, the clock starts. You've got hours, maybe a day, to post additional capital. If you're a professional fund with deep pockets, no problem. You wire the money, you stay in the trade. But if you're a retail trader using 50-to-1 leverage, or if you're already at max capacity, you've got a problem. You can't post more margin. So your broker starts liquidating for you. They don't ask permission. They hit the market with sell orders to reduce your exposure back to acceptable levels. And those sell orders hit a market that's already nervous, already thin on liquidity, already looking for exits. Third, those forced sells push prices lower. And when prices fall, other traders who weren't even close to margin calls suddenly are. Their positions deteriorate, their account equity drops, and now they're facing the same choice: post more cash or get liquidated. So a second wave of selling hits, then a third. Each wave feeds the next. That's why you see these waterfalls in price. It's not that everyone woke up and decided silver is worth 33% less. It's that the mechanics of leverage created a self-reinforcing loop. But here's the part that should make you pay attention. As this was unfolding, you had reports of positioning shifts at major banks, temporary disruptions at the London Metal Exchange, and even systems issues at HSBC floating around the same window. JP Morgan Chase, the LME, and the banks all deny any coordination. And to be fair, there's no proof of a smoking gun. But when multiple stress points line up during a margin event, the effect is asymmetric. Big players with balance sheets ride it out. Leveraged retail traders don't. And here's the part that should make you nervous if you're not paying attention. This kind of move doesn't need panic. It just needs math. Now let me add another layer because it's important. When you see disruptions at the LME or issues at major banks during a volatility spike, it raises questions. Are those issues coincidental? Are they technical glitches that just happen to occur at the worst possible time? Or is there something more coordinated happening behind the scenes? The honest answer is, I don't know. You don't know. We can't prove intent, but what we can observe is the outcome. When systems go down or when liquidity dries up at exactly the moment margin calls are hitting, the traders who get hurt are the ones without deep pockets. The ones who can't move positions easily. The ones who can't call a prime broker and work something out. What validates this theory is the speed of the collapse and the volume patterns. If this were genuine fundamental selling, you'd expect distribution over time. You'd expect large holders to exit carefully, trying to get the best price. But that's not what we saw. We saw liquidation prints. We saw market orders hitting bids with no regard for price. We saw volume spikes at the exact moments you'd expect if margin calls were executing. That's not bearish sentiment. That's forced unwinding. And here's the convergence that makes this so clear. You've got rising margin requirements, you've got thin liquidity, and you've got system disruptions all happening in the same 48-hour window. Each one alone would create volatility, but when they overlap, they create chaos. They create exactly the kind of move we're seeing. And if you understand that convergence, you understand why this isn't random. It's structural. It's predictable. It's the kind of thing that happens every time these conditions line up. This is the exact same playbook we've seen before. Go back to 2011, when silver went parabolic and then margins were raised repeatedly. I remember that period clearly. Silver ran from $30 an ounce to nearly $50 in weeks. It was euphoric. Everyone was calling for $100. And then the CME stepped in. They raised margins 5 times in 8 days. 5 times. Each time they raised them, volatility exploded into the close. Prices overshot to the downside. Leveraged longs got absolutely crushed. And only after the forced selling ended, only after margin requirements stabilized, did the market even attempt to form a base. It took months for silver to recover, and it never got back to that $50 high for over a decade. What happened next in that case? Silver eventually found support in the mid-20s, but the damage was done. The parabolic structure was broken. The momentum traders were gone, and the market had to rebuild from scratch. But here's the lesson. Every time the requirements jumped, the same pattern played out. Forced selling into the margin deadline, overshoot to the downside, then stabilization once the pressure valve released. Same pattern we're seeing today. Or look at March 2020. Different asset, same mechanics. When COVID hit and markets collapsed, volatility exploded across every asset class. Margin calls went out across equities, commodities, bonds, everything. And what happened? Liquidation. Chaos. Funds that were perfectly healthy on paper got destroyed because they couldn't meet margin calls in real time. Even gold, the ultimate safe haven, got sold into that mess. Not because it lost value fundamentally, but because people needed to raise cash. They sold what they could, not what they wanted to. And silver? Silver got destroyed worse than almost anything. It dropped from $18 to $12 in days. Was the fundamental case for silver weaker in March 2020? No. Industrial demand was uncertain, sure, but the monetary case was stronger than ever with central banks printing trillions. The move was mechanical, not fundamental. And here's another precedent that's worth understanding. Go back to the commodity supercycle peak in 2008. Oil hit $147 a barrel in July. By December, it was at $35. Did global oil demand drop 75% in 5 months? Of course not. What happened was a massive deleveraging event. Hedge funds, banks, speculators, they were all unwinding positions simultaneously. Margin calls forced selling, liquidity vanished, and prices collapsed far beyond what fundamentals justified. Then what happened? Once the liquidation finished, once forced sellers were gone, oil stabilized and eventually recovered. Same pattern. Forced selling creates overshoot, then stabilization, then recovery. When you zoom out, you see the pattern clearly. Margin hikes don't end moves immediately. They compress them. They pull future selling into the present. They create short-term chaos that eventually resolves once the pressure is released. And that's exactly what we're watching in silver right now. This move was mechanical, not emotional. It was structural, not random. Fundamentals didn't vanish in a week. And if history rhymes, stabilization comes after the pressure valve finishes releasing. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this just be a genuine collapse in demand? Could silver really be worth 33% less in a week on fundamentals alone? Let me be honest, that's a stretch. Industrial demand doesn't shift that fast. Jewelry demand doesn't evaporate overnight. Central bank policies haven't changed drastically in a week. So fundamentally, does it make sense? Probably not. But I'll say this. Markets can remain irrational longer than you can remain solvent. Just because something doesn't make fundamental sense doesn't mean it can't happen or persist. Could there be secret coordination between exchanges, banks, and clearinghouses to engineer this move? Maybe. I've seen conspiracy theories floating around suggesting exactly that. And look, I'm not going to sit here and tell you that big players never coordinate or never manipulate markets. History shows they absolutely do. But here's the thing. It doesn't actually matter whether there was coordination or not. The mechanics are what matter. The outcome is what matters. You can't trade rumors. You can't trade theories about what might be happening behind closed doors. You can only trade what you can observe. And what we can observe is margins rising, volatility expanding, liquidity thinning, and forced selling showing up exactly when the rulebook says it should. Could this be the start of a longer-term bear market in silver? Could we be looking at a fundamental shift where silver goes back to $60, $50, lower? Yes, that's possible. Maybe the run to 120 was the top of this cycle. Maybe we're in for years of consolidation or decline. I don't have a crystal ball. But what I will say is this. The speed and structure of this move suggests it's not fundamental. Fundamental moves take time. They distribute. This was liquidation. This was mechanical. And mechanical moves tend to reverse once the pressure is gone. So here's what I want you to take away from this. Focus on what you can control and what you can observe. Margins rising? Observable. Check the CME website. Volatility expanding? Observable. Check the charts. Liquidity thinning? Observable. Look at bid-ask spreads and volume. Forced selling showing up at margin deadlines? Observable. Watch the tape. Those are facts. Those are things you can verify. Everything else, the theories, the conspiracies, the predictions, those are noise. Trade the signal, not the noise. There are probably 3 types of people watching this right now. The first is already in silver and feeling that knot in your stomach. Maybe you bought at $110. Maybe you added leverage at 90. And now you're watching your account bleed and wondering if you should hold or fold. You're not crazy for feeling that stress. This is what leverage pressure feels like. This is what forced liquidation looks like when you're on the wrong side of it. For you, survival matters more than prediction. If you're overexposed, if you're close to margin calls, reduce risk so tonight doesn't make decisions for you. Take the loss if you have to. Protect your capital. Because the market will give you another chance, but only if you're still in the game. Don't let ego or hope destroy your account. Be honest about your situation and act accordingly. The second group is sidelined and frustrated, watching prices fall and wondering if this is the bottom. Maybe you sold earlier and you're kicking yourself. Maybe you've been waiting for a pullback and now you're wondering if this is it. For you, patience is a position. Let the margin event finish. Let tonight pass. Let volatility tell you when selling pressure actually exhausts. Because trying to catch a falling knife during forced liquidation is how you get cut. Wait for confirmation. Wait for volume to dry up. Wait for volatility to contract. Wait for some sign that the forced sellers are done. Then you can start looking for entries. But don't rush it. The bottom isn't going to run away from you. The third group is skeptical of the whole thing, thinking this is noise and silver's going to $50 or lower. And you might be right long term. Maybe the commodity supercycle is over. Maybe we're entering a deflationary environment where industrial metals collapse. I'm not here to tell you you're wrong, but even long-term themes get temporarily wrecked by short-term mechanics. Even if you're bearish on silver structurally, understanding that this move was amplified by margin pressure matters because it tells you where support might form. It tells you when oversold conditions might resolve. It gives you better entry points for shorts or better exits for longs. Don't dismiss the mechanics just because you have a long-term view. The principle that applies to all of you is simple. Respect liquidity, especially when rules change. When margin requirements shift, when volatility spikes, when systems go down, liquidity disappears. And when liquidity disappears, prices can go anywhere. They can overshoot to levels that make no fundamental sense. And that's dangerous if you're positioned wrong. But it's also opportunity if you understand what's happening and you're prepared. So here's what I want you to answer in the comments. Which group are you in? Are you holding and stressed? Are you sidelined and waiting? Or are you skeptical and bearish? Tell me where you stand, because I want to understand who's watching this and how you're thinking about this move. And if you've been through margin squeezes before, tell me what you learned. Share your experience so others can learn from it. Now, here's where I stand. I'm not chasing panic, and I'm not calling a bottom just to sound brave. I'm watching 3 things very closely. First, I'm watching whether silver can hold that $80 to $82 zone into the close after margins kick in. If it holds, if we don't see another leg down tonight, that tells me forced selling might be exhausted. It tells me the worst of the liquidation could be behind us. But if it breaks below 80, if we see another flush, then I'm looking lower. Second, if selling does accelerate, I'm watching whether $70 to $75 acts as a final washout rather than a trap door. That's roughly where some longer-term support levels sit. That's where you might see value buyers step in. But if it falls through that with volume, then all bets are off, and we could be looking at a much deeper correction. Third, I'm monitoring whether volatility contracts after tonight. Because contraction tells you forced selling is done. Contraction tells you the market is stabilizing. And stabilization is what you need before you can even think about entries. Based on my analysis, this move was mechanical. not emotional. It was structural, not random. The fundamental picture for silver hasn't changed in a week. Global debt is still rising. Central banks are still printing. Industrial demand for solar and electronics is still growing. Geopolitical tensions are still elevated. None of that changed. What changed was leverage. What changed was margin requirements. And that created a forced unwinding that pushed prices far lower than fundamentals would suggest. If history rhymes and silver stabilizes after this margin event resolves, the move that follows could be significant. I'm not saying it will be. I'm saying the setup exists. But timing matters, structure matters, and right now, we're still in the liquidation phase. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the CME margin requirements yourself. Look at the charts yourself. Form your own thesis. Don't take my word for anything. Your money, your decisions, your responsibility. If you made it this far, you're the kind of person who actually wants to understand markets, not just react to them. That mentality will serve you well. Most people panic. Most people follow headlines. Most people get wrecked by moves like this because they don't understand the mechanics. But you took the time to learn. You took the time to understand why this is happening, not just that it's happening. And that puts you ahead of 90% of traders out there. If this breakdown helped you see what's really driving this move, share this video with someone who's confused or stressed about what's happening in silver right now. And if you're not subscribed yet, hit that subscribe button, because I'm going to keep breaking down market mechanics like this. I'm going to keep showing you how to spot these patterns before they wreck you, or how to position for them when they create opportunity. Stay sharp out there. Think critically. Verify the data yourself.